Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be talking about tax loss harvesting, a technique that can help investors lower their taxes that they have to pay at the end of the year. We'll talk about what it is, what are some of the criteria for you to consider to take advantage of tax loss harvesting. Besides, we'll respond to a question from one of our followers on Blossom, how to look into an ETF fact sheet and what to look for when looking at those files. Without any further ado, let's get into this. Tax loss harvesting is a technique that can be used by investors to actually significantly reduce their tax burden potentially over time. In a nutshell, tax loss harvesting refers to investors selling an investment within a non-registered account, such as a stock or a bond, for less than their adjusted cost base or ACB, which as a result triggers a capital loss. The adjusted cost basis is actually pretty much referring to the book value of the purchase, as well as any other costs incurred in acquiring that property, such as, for example, any commissions or legal fees paid. In your case, so let's say if you bought shares of a specific stocks, the total amount paid for that, the book value plus any fees, is considered that adjusted cost basis. Now, if over time that stock or property that you have, in this case, let's say a bond or stocks or ETF, lost its value, you could be able to actually take advantage of tax loss harvesting by selling that at a loss and then applying that loss against any capital gains. In other words, those capital losses could offset your capital gains that you've had, and in turn reducing the amount of taxes that you would owe as a result of those capital gains, or possibly even nullifying them altogether. Just to illustrate the tax loss harvesting, how it works with an example, let's say you invested $5,000 in an energy company during this year, and the value of that stock, as an example, have now dropped from $5,000 that you spent on it is now worth only $4,000. In other words, you have an unrealized loss of $1,000. If you manage to actually decide to sell your entire holding in this example, you would have a realized loss of $1,000 for your initial investments. What you can do through the use of tax loss harvesting is that $1,000 in loss can be offset against, let's say, an amount of $1,000 that you might have had during the year through a capital gain. So let's say you had another stock that actually returned very well for you and you managed to sell it. And from that sell, let's say you have at least $1,000 in profit or even more, and that $1,000 of loss can be offsetted against $1,000 of capital gain. In other words, lowering the amount that you owe in terms of capital gains on taxes. It could easily truly nullify that if, let's say, the amount was exactly equal, let's say $1,000 loss offset it against $1,000 of capital gain, or at least lower it. So for example, let's say you had shares of Apple, it gained quite nicely during the year and you managed to sell it at a profit, some of it, and had a capital gain of $3,000. You could easily lower that capital gain of $3,000 to only $2,000 by reducing that $1,000 that you had in the losses from that amount to the approach of tax loss harvesting. Keep in mind that tax loss harvesting is only applicable in non-registered accounts, so you cannot take advantage of this technique, let's say, in a tax registered account such as a retirement account, TFSA, or RSP accounts. Another key consideration for you is to avoid any superficial losses. CRA, then Government of Canada, Canada Revenue Agency is very particular about this. What they mean by superficial loss is, as the website reads, a superficial loss can occur when you dispose of a capital property, say a stock, for a loss, and both of the following conditions are met. You or a person affiliated with you buys or has a right to buy the same or identical property, called substituted property, during the period of starting 30 calendar days before the sale and ending 30 calendar days after the sale. Let's say, if you or a person affiliated with you still owns or has a right to buy the substituted property 30 calendar days after the sale. And they also specify what they mean by affiliated person. In a nutshell, and this is not a tax advice, but in a nutshell, how I interpret it is that, say you sold shares of Enbridge and you had a capital loss on it. You cannot actually go ahead and buy the same shares of, let's say, Enbridge within the next 30 calendar days, because it's just it proves to be almost like a what they call as a superficial loss. In other words, you just sold it to trigger a capital loss, but again, going back and buying the same shares. or let's say in this case, going back and buying shares of a very identical type of company. Tax loss harvesting can be used to rebalance the portfolio. It could actually be a very effective strategy in that sense. So, say if you want to rebalance your portfolio by sectors or even by geographical exposure, depending on the stocks or bonds that you're trying to sell. Keep in mind as well that tax loss harvesting only applies to investments sold in non-registered accounts. So CRA does not allow the use of capital losses within registered accounts to offset gains in other accounts. Another thing to consider is the year-end deadlines. To offset gains realized in a calendar year, losses must be settled within that same year. So there is a consideration that your capital losses can offset your capital gains in the current tax year. You can also carry back those capital losses for the 3 preceding years, or carry them forward indefinitely until you can apply them and offset a capital gain. Lastly, to answer a question that was raised on Blossom related to how to look into fact sheets for an ETF and what to look for, I'm just going to show you 2 examples from 2 of the ETFs that are very popular on Blossom. The first one being XEQT. If you see on that, when you go to the ETF page on BlackRock, and you can easily find it through Google. Just search for XEQT BlackRock Canada. There's a button for fact sheet. When you click on it, it opens up a PDF file. A few things for you to take note of is, first and foremost, these fact sheets gets updated quite frequently. So take a look at it. What was the last date it was updated? In this case, this is as of end of November. If a few other details that you see, typically fact sheets are quite short, usually 1 to 3 pages max. Talk about what is that ETF do as a whole, what type of benefits it offers. It also has some segments such as key facts. What was the launch date for the ETF? In this case, you do see for XEQT, it was launched back in August 7th of 2019. It is available through Toronto Stock Exchange. How frequently it does pay its dividend distributions, in this case on a quarterly basis, and whether it's eligible for registered plans, which the answer is yes. It consists of 4 different ETFs as its underlying holdings. It talks about its fees. The fee that you want to really focus on is the management expense ratio, MER, which is the all-encompassing fees. And you're not going to see it actually coming out of your account. The management expense ratio, MER, is actually taken out of the performance for the fund. So in this case, for XEQT, it has a management expense ratio, MER, of 0.20%. It does show you what are the holdings and the percentages, as well as what would be the growth, hypothetical growth of $10,000 invested since inception. It's shown to the graph for you. Scroll to the next page. It does further down. It shows you the annual performances as well as performances by calendar year. Even though the fund was incepted in early August of 2019, it's not showing a calendar year performance because it was not a full year, but it does show you through the annualized return since the inception date, as well as you have the annualized return since inception. 3-year, 5-year, and 10-year. 5-year and 10-year are not applicable given the date that XEQT was launched. Since inception of XEQT, the annualized return is at 9.36% at the end of November of 2023. If you scroll down on the second page, it shows you what are the aggregate underlying holdings, even though the holdings consist of 4 ETFs. If you look at the underlying holdings within them, the biggest exposure is to Microsoft at 2.95%. Following that, we have Apple, Royal Bank of Canada, Amazon, and Toronto Dominion Bank among the top 5 holdings. It has also some other portfolio characteristics such as the price to earnings ratio, trailing 12 months, price to book ratio, distribution yield, and trailing 12 months yield. The trailing 12 months yield is the one that is you want to probably look at, because for funds such as XEQT, the amount of the dividend distributions that it pays, it kind of has some cyclicality. So 1 month, one quarter is higher, then the next quarter is lower, then it goes back up, down, up, down. But if you look at the trailing 12 months, it takes into account all of that, which hovers around that 2% yield for it. And some other disclaimers. On the third page for XEQT ETF fact sheet, it talks about its alignment with sustainability characteristics, the environmental, sustainable, and governance score, which is currently at 6.88, based on a score of 0 to 10, and a few other details that is showcased for you here. VEQT, another popular all-in-one ETF. If you look at it, on top of the page, there's another link for fact sheet. If I click onto it, you do see there's a 2-pager PDF that comes up, very similar to XEQT. It talks about the fund's objectives, its strategy, the ticker symbol, availability on Toronto Stock Exchange. With VEQT, it does pay its dividend distributions annually, only once a year. The inception date is earlier and goes back to January 29th of 2019. Talks about the return as well by different calendar years performance wise, net of expenses. So the expense, the MER is taken out of these performance. So this is net. The MER for VEQT is slightly higher at 0.24%. As well, you do see the return based on the net asset value as well as market price for the past 3 months, year to date, 1 year, and 3 year, as well as since inception. Keep in mind the inception date for VEQT is different from XEQT. It was a bit earlier, so you can't actually exactly compare them head to head. But what you can compare is their 1 year returns or 3 year returns, because they both have those data points available for you, as well as, let's say, year to date or 3 months, 3 months, if that's something that interests you. Further down on the second page, you talk about how many stocks is available within VEQT through the underlying holdings, which are some other ETFs. Indirectly, you're getting exposure to over 13,000 companies. With XEQT, you get exposure to over 9,000 companies. So with VEQT, you have higher number of companies within it. Price to book ratio, price to earnings ratio, and a few other key metrics are showcased for you here. Thank you so much, everyone, for watching this video until the end. I hope you found it beneficial and hopefully provided you some value. If you did find it beneficial, I appreciate if you can give this video a thumbs up and subscribe to our channel here on Momentum and Blossom. We post weekly videos about investing, including investing in the stock market, as well as ways to reach financial freedom. Thank you, and I hope to see you all next time.